Hello and welcome to Australia Talks. I'm Paul Barclay and you're on ABC Radio National or listening via the web. Hope you had a good start to the working week. Took me a while to get going this morning, I must admit. Are you like me? Are you finding yourself looking at the rampaging Australian dollar and thinking, gee, wouldn't it be a good time to go overseas right now? When I was last in the US, in New York, the Aussie dollar bought not much more than 50 US cents, and when in England, it was almost 3 Australian dollars to the pound. How things have changed. Just this morning, our dollar was trading at US $1.07, a bit over, and that was more than a third of a US cent higher than Friday. Some experts say the high US dollar is here to stay. And while it is indeed great news if you're planning to travel or buy from overseas, for many local businesses like exporters or those in the tourist industry, it's really tough. What does the high Aussie dollar mean for you? Are you taking advantage of it in some way, or is your business feeling the pinch? Call now on 1300 22 55 76. Call right now from the Northern Territory and South Australia, or post your comments online on our message board at abc.net.au/rn/Australia Talks. Let me introduce you to your guests for today. Peter Byrne is Director of Public Policy at the Australian Industry Group, and Dr. Shane Oliver is Head of Investment Strategy and Chief Economist at AMP Capital Investors. Peter Byrne, to you first of all. Welcome to Australia Talks.
Thanks very much, Paul.
The Australian Industry Group must look at the dollar's ascent with rather mixed feelings. How punishing is the high dollar for our export-focused businesses?
Well, it is very punishing for exporters who are outside of the mining sector and who don't have the degree of margin in that sector. It's also punishing for import competing businesses because the price of imported goods falls relative to Australian produced goods, and so a lot of businesses, so for example in the steel industry, who are already under pretty intense import competition, have found that competition intensify quite considerably with the rise of the dollar to very high levels in historical terms, so that it's around about 40% above post-float averages at the moment, and a lot of that has happened relatively quickly, and that has put quite a big shock under a lot of exporting and import competing businesses.
Absolutely, with not a great deal of time to adjust. Are we talking here about loss of profitability, laying off of staff? How bad is it in those industries that are affected?
Well, it's hard to generalise with a single thing, but certainly erosion of margins, loss of profitability, that's for sure. In some cases, job losses, plant closures and the like, and in some cases businesses radically transforming themselves, no longer seeking inputs from an Australian supplier but seeking them from abroad, maybe investing investing abroad in either to supply either the Australian market or their export markets. So a variety of responses, Paul, difficult across the board, but people with big slabs of fixed capital invested don't really have the capacity to shift that around a hell of a lot, and so they just wear an erosion of margins in the short and medium term.
Are we talking about certain industries in particular? Tourism clearly has had a lot of focus, but tourism aside, what are the type of industries that are most affected?
Well, the other big sector and a very big employing sector that's affected is manufacturing. Very exposed to trade. Most of the sector is import competing. A fair bit of the sector is reliant on exports, and so that's pretty hard pressed at the moment. I think that good seasons aside, we'd also be seeing the same sort of problems in many agricultural industries. Many of those industries are currently having boosts from other directions, but take those boosts out of it, and I think that agriculture would be under a fair bit of pressure as well.
Shane Oliver from AMP Capital Investors, let me bring you into the discussion. Is a high dollar better than a weak dollar overall for the economy?
I'd have to say yes. There's no doubt that it's causing a lot of pain for those industries that Peter mentioned. But against that, if a low dollar was the way to prosperity, then countries like Zimbabwe or Bolivia would be the world's richest countries, and of course they're not. Countries which have done well globally in terms of wealth levels and income levels tend to have strong currencies over time. So my feeling is that, yes, it's painful, but overall I think a strong Australian dollar is better than a weak one.
Just on that, Peter Byrne, do you agree with that in principle, that the high Australian dollar is a good thing?
I think that it's probably the other way round, that the high Australian dollar is a result of some good things, so that in this case it's a result of the good thing that's coming, the wave of demand that's coming from the emerging economies, and we're able to sell them a hell of a lot of mineral exports. And so I don't know, it's certainly good if you're travelling, as you mentioned at the beginning, or you're importing goods and services, or you're buying imported goods and services. For businesses in other parts of the economy, it's not. So I think the cause and effect is interesting.
Yes. I was just going to say, in a sense, we're all importers these days because we've got a computer screen in front of us and we can buy and source so many products from all over the world where the currency rate is favourable to us. And as we've heard, that's also having some impact on retailing. But Shane Oliver, if I can... Sorry, go Peter.
Oh, I was just going to add, I didn't mean to cut you off there, but for many manufacturers there's a positive side to it all as well, and it's part of the complexity of the economy, of course, because many manufacturers import some of their inputs, and they also import much of their capital equipment, and the higher dollar has made capital equipment less expensive for manufacturers here, and the inputs that they've been sourcing from China or Thailand or whatever else are also now somewhat cheaper than they were with the dollar at lower levels.
Yes, clearly a mixed blessing. Shane Oliver, let me come back to you because Peter Byrne then talked about mining, the fact that even though it's an export industry, it's still doing well at the moment, our biggest export industry. Is mining not hurt by the high dollar because of the sheer demand for our commodities?
Well, that's basically it. I mean, obviously, as the Australian dollar rises in value, then it does hurt the mining sector, all things being equal. But, of course, all things aren't being equal. We're seeing big increases in commodity prices for iron ore, coal, copper, and so on. And so, therefore, there's a natural offset. And, of course, the mining sector is increasingly able to sell more internationally because of that very strong demand. So were it not for that strength in commodity prices, the mining sector would be hurt as well, but it does have that natural hedge. And I might say big chunks of the agricultural sector are in that same boat. We've seen huge increases in prices for many grains, cotton, and other agricultural commodities which have provided an offset to the strong Australian dollar for the agricultural sector. So it's basically the resources sectors, whether it's agriculture or mining, which are somewhat protected. And, of course, as Peter pointed out, the strong Australian dollar reflects the good fortune those sectors are now currently seeing.
How have the currencies of other mining competitors, other mining countries such as Brazil and Russia been doing? Have they risen at all? Is that part of the reason why Australian mining is not so disadvantaged?
Well, it's certainly the case that the Australian dollar has been lumped together with other commodity currencies. The other main ones are, of course, the Canadian dollar is a big one. The Brazilian real has been under a lot of upwards pressure, and that partly also reflects very high interest rates in Brazil in double digits, which of course attracts money into Brazil, along with the high commodity prices. The South African rand. And so all these currencies have been under upwards pressure, so it's not as if Australia has been singled out. I might also add that we haven't risen nearly as much against, say, the euro as we have against the US dollar.
Yes.
So, yes, there is a very strong Australian dollar story here, but there's also a weak US dollar story, which has seen many other currencies go up against the US dollar, albeit not as strongly as the Australian dollar has.
We hear a lot, Shane Oliver, about the high dollar accentuating the two-speed economy, some industries and some parts of the country booming, like mining, others like tourism and other parts of the country too, doing poorly. This is a problem, isn't it? Because it can lead to the prospect of higher interest rates, and the Reserve Bank is very soon to contemplate increasing rates at a time when much of the economy is in fact sluggish.
Well, that is a problem, and unfortunately the two-speed economy is an outworking of the mining boom that we're currently having. I guess at the end of the day, the strong Australian dollar is also part of the solution, because what's basically happened here is that demand for one key part of the economy, or two key parts if you include agriculture, has gone up. The prices received in those areas has increased globally as commodity prices have increased. And that, of course, means that those sectors are now more profitable than other parts of the economy, such as manufacturing and services. And so in a free market economy, what needs to happen is resources need to shift into the mining sector and, of course, to some degree into the agricultural sector without overheating the economy. And one of the mechanisms that achieves that is, of course, the strong Australian dollar. It makes manufacturing less competitive. Mining sector, of course, is less affected, and, of course, that frees up resources in the economy to shift into the mining sector. So, of course, it does accentuate the two-speed economy, but it also facilitates the adjustment in the economy, switching resources, if you like, that's human capital and machinery and what have you, into the part of the economy that's doing very well,
yes,
without at the same time the economy overheating.
As ever, a complex picture, as ever. Peter Byrne, just before I take some calls, is there anything that the government can do, any way in which it can intervene to deal with this problem, in some part problem, of the high Aussie dollar and also the problem that it feeds into this two-speed economy? And there are a number of people saying that we're staring down the barrel of another interest rate rise.
Well, I think that the interest rate rise is certainly on the cards a bit later on in the year at least. But the question of whether the government can do anything, well, there's no doubt that it can. The consequences need to be looked at very, very carefully. One of the things that we find very interesting that the Norwegians have done, they also have an economy that's vulnerable to shocks in commodity prices. And what they've done is to set up a sovereign wealth fund which is invested in non-Norwegian assets. And so it is financed by a slice of the revenues from their mining sector, in that case oil, and that as the revenues come in, they are reinvested in assets abroad. Now what that does is not only provides a store of wealth to replace the lost oil, but it also counters the currency movements so the money coming in for the oil sales is going out in these purchase of assets abroad. And that is making their currency, the argument is that makes their economy much less vulnerable to this exchange rate driven restructuring, which is very, very much at the mercy of international commodity prices. And so the argument is that sovereign wealth fund, the Norwegian sovereign wealth fund, has reduced the volatility and the exposure of that economy without undermining the resource allocation and the sort of efficiencies that Shane was talking about.
Talking to Peter Byrne from the Australian Industry Group and Shane Oliver from AMP Capital Investors, taking a look at the impact of the high Aussie dollar. Love your thoughts. Are you affected by it? Are you feeling the pressure? Perhaps it's hurting your business, or you're planning some overseas travel where you'll get some of the benefit of that high Aussie dollar. 1300 22 55 76. James online says manufacturers have been moving operations offshore for decades despite a low Aussie dollar. Secretly, I suspect they're rubbing their hands with glee now that they have another excuse to operate in a country with cheaper labour. Let's go to Robert in Melbourne. Hello, Robert.
Hi, how are you?
Good, thanks. You've been taking a look at some of those prices on the internet, have you?
Well, look, I'm retired or semi-retired, living on a reasonably small pension plus casual work, and I just go out looking for the best prices I can get, and lots of those are from, on the internet, lots of those are from Australian firms. I won't mention any particular ones.
Yeah.
But some are overseas.
That's right.
I just, I just have to do that to get the best value, if you like, for my dollar.
So in a sense, you're using the high Aussie dollar and indeed the low US dollar as a way of purchasing to deal with some of the cost of living pressures that are going on at the moment.
That is right.
Yeah. And I'm sure that you're not the only one, Robert. If you have a similar story to tell, give us a call, 1300 22 55 76. Hugh is on the blower from North Queensland. Hi there, Hugh.
Well, I'm trying to learn to fix washing machines because our local Fisher and Paykel washing machines don't last in the bush. They're supposed to be a modern computerised technology. So I've gone for the American Maytags and Clean-Made washing machines that I get from the local rubbish dump, and I thought that the Americans, that their parts would be cheaper than our local product, and it's $88 for a motor test at the local shop on the table there. It's $134 for a house call, and it's $390 for a new motor delivered. So I don't think it's a high Australian dollar. I think we've got runaway inflation.
Okay, Hugh, thanks for that. Hugh's not finding any benefit from US washing machine parts. Give us a call, 1300 22 55 76, or post your views online on the Aussie dollar, the upside and the downside, whichever side you're experiencing. Let's hear now from Barry Upfold. Barry is Regional Chair for Queensland of the Executive Connection, a global CEO networking community. Barry, welcome to Australia Talks.
Thank you, Paul.
You say that the high dollar has little impact on small and medium-sized businesses. This is the result of a survey that you've conducted, is that correct?
That's correct, yes.
Tell us about that.
Okay, we asked the question, has the strength of the Australian dollar had an impact in your business? And from a positive point of view, nearly 36% of those polled said it had a positive effect. 41% said it had no effect. And there was a negative nearly 23%. And I suspect that one of the major reasons for this is that a dollar is a dollar in Australia, and a lot of our membership, and I think a lot of SMEs, are doing business within Australia. They're not exporting.
They're not exposed, in a sense, to those fluctuations.
That's correct. But they also benefit from the high Australian dollar in terms of what one of the other gentlemen was talking about earlier on, about raw materials and capital equipment coming into the country.
Yeah. How about the prospect of the dollar rising even higher? Could that be of concern, or is it equally, as you say, unlikely to have much effect?
Well, I think at this particular, it just depends on how high it gets. I mean, if it got up to like $1.20 or something like that, then I think that it has to have some effect. Although even under those circumstances, 59% of our membership said no, it wouldn't have any effect on them. And a lot of our members also are in the professional services businesses. So, but we do have manufacturers, and manufacturers are getting a benefit from it.
Yes. One industry sector, of course, that's being hit around quite a bit by the high Aussie dollar is the tourist sector. They've been quite badly affected. I would have thought there'd be quite a few small businesses in this sector.
We do have, and they are the ones that are in the 23% negative.
Yeah.
And also, from a retail perspective, where you've got a discretionary purchase, say like a remodelling of a kitchen or something like that, the dollar hasn't had an effect on that, but the interest rates certainly have, from a confidence perspective, in terms of consumers not, putting on hold the purchase of that. But certainly some of our members who are in we've got one member who has a camper van business rental. And they've been affected by various things, not only the strength of the Australian dollar, where Australians are going overseas for their holidays and so on, but also because of natural disasters in various places that have stopped people like backpackers, etc., coming to Australia.
Yeah. Peter Byrne, could it be the case that the high dollar is worse for big business rather than small business?
Oh, it could be. Big businesses are more exporters are more likely to be bigger businesses than are small businesses. So that's one area. But I think that what we have, without a doubt, is a two-speed, or we prefer to think of it as a multi-speed economy. And I think the breakdown of responses to this survey is perfectly in line with that. So, you know, the absolute numbers are going to vary depending on what sectors are included in the survey, and a high level of professional services, probably not overly exposed to import competition and perhaps not exporting very much. You're going to have that the balance of those, but people will be adversely affected, some will be positively affected, and some will be neither positively nor affected. So I don't think that the survey result is terribly surprising. I mean, it's always interesting to see these surveys, but it fits in perfectly with what we're seeing in these multi-speed economy.
Yeah, good to talk to you. That's Peter Byrne, the Director of Public Policy for the Australian Industry Group, and Barry Uphold, who's the Queensland Regional Chair for Executive Connection. As I mentioned, Australian tourism operators have seen the cost of travel to Australia skyrocket with the rising Australian dollar. Just last week, coincidentally, liquidators were appointed to the Curran Cove Island Resort on South Stradbroke Island in southeast Queensland. And to talk about the impact of the high dollar on tourism, you're joined now by Tony Baker. Tony is the Managing Director of the Quicksilver Group in Cairns, which operates cruises. Welcome to Australia Talks, Tony.
Thank you. Very nice to be here.
Yes. How is the dollar affecting your business?
It has a significant impact on our business in a number of ways. Firstly, with the domestic market or the domestic traveller, the high Australian dollar certainly makes it more attractive to head overseas. And also for those people who do come up to the region, they're not necessarily spending as much money as they would have in the past. So, but domestically, the main issue would be the attraction of going overseas. On the international market, on the other hand, I guess there are a couple of impacts. There's still that market that certainly comes. For a lot of those people, they travel on a budget, and if you have a very high Australian dollar compared to their currency, they're less likely to spend more money when they're here. And then there's another section of the international market which looks at the high cost of coming to Australia and simply chooses to go somewhere else.
Would you say the biggest impact on tourist operators is the Australian tourism market that's chosen to travel overseas because of the attractive dollar, or the reduction in the number of foreign visitors here?
You know, it's quite an interesting thing. In the past, when there have been big challenges overseas, the Australian tourism market has focused more heavily on the domestic market. Right now, the domestic market, because of the high Australian dollar, is heading overseas in droves. I would tend to think that the impact of the outbound tourist is perhaps having a more significant impact because it's taking away that fallback that the industry's always had, particularly in some of the more international destinations.
What can you do about it, do you think?
It really is a challenge. I mean, we would certainly like people to try and, or the government to try and do something to encourage Australians to holiday at home. Exactly what that is, I'm not sure.
Yeah. All the best, Tony. Good to talk to you, and hope business picks up for you. Tony Baker, the Managing Director of the Quicksilver Group in Cairns. Love your thoughts about the high Aussie dollar too, how it's affecting you, whether you're one of those who maybe in the past wouldn't have thought about going overseas because it was just out of your price range, but finding the thought of maybe a trip to the US is all of a sudden doable. Or, you know, perhaps you're in business and you've been hit. Give us a call, 1300 22 55 76. A good time to ring now. There is a spare line. Let me go to Gerard on the line from Melbourne, who is, I think, a manufacturer. Is that right, Gerard?
That's right, yep.
How are you affected?
Well, we're a small company, 15 people, 20 years old, and we're now exporting around 95% of our high technology measurement systems worldwide, which is great, but the high dollar has really knocked us around, the way we respond is, well, we're only small, we don't expect anybody the government to do anything. So one of the aspects is that I've said to my production manager, okay, global source. So that means there are no borders, there are no local agents. We just go wherever we can in the world to get the lowest cost components, put them in machines and send them back. We're leveraging the power, say, of China's lower cost components against Chinese companies that are copying our equipment. It's the only way. It's a reality. It's brutal, but it's all we can do.
Reducing the cost of the imports.
Well, the cost of imported components has fallen. So
yes.
Instead of sticking with the same suppliers in Australia we have been for years and making every component here, we've had to go off overseas to get the lower cost components so we can keep manufacturing.
To try and offset, obviously,
right.
the cost. What would you say, though? How much has the end cost of what you manufacture increased to those people purchasing it overseas?
Well, we have contracts with major US-based companies, and they just won't tolerate a lift in price. So we've absorbed that 35% change in.
Really?
Now, for years it was fantastic, but now it's just tougher. So we've had to just cut costs and cut the equipment. We're looking at things like, instead of printing manuals now, we just give them on a PDF on a memory stick. Everything is on the table. Any components we can get overseas or get a machine, and it's so quick with the internet to compare prices that's the way we react.
Look, I think that's a great insight into how business is adapting, Gerard, and I thank you for calling. Let's quickly go to Brisbane and Chris, who's a financial planner. Hello, Chris.
Oh, hi. Good evening, and thank you for taking the call.
Are more people looking overseas to invest at the moment because of the dollar?
Well, it's really clear. I mean, over recent years, I've been doing this silly job for 20 years, people have been focusing on, the dividend imputation aspect of buying Australian shares, and that's been wonderful. But now with the Australian dollar at these sorts of levels, and, the anguish that many investors are feeling across many sectors, not least of which is the unknown impact of the carbon tax, we're going to see capital flight from Australia. Capital flight. I mean, Mr. Palmer has been trying to sell $3 billion worth of capital overseas for the past 6 years, but he hasn't seemed to be able to get the timing right. But that's just an indication of people who are looking to sell the Australian dollar at these levels. And it's as simple as that, really.
Look, thanks, Chris. And we're going to talk about investing in shares toward the end of the program tonight, and whether or not the high Aussie dollar is affecting what people are investing in. But how does the investment community see the high Aussie dollar? Well, Nathan Lear is private client advisor with the wealth management firm Hewison Private Wealth, and he joins you now. Nathan, welcome to Australia Talks.
Hi, Paul. Thank you.
What do you think is pushing the dollar so high?
Well, we really see there's three main factors which are pushing the dollar so high. Now, we've discussed those a little bit earlier, but just briefly, the strong commodity prices and the Australian dollar, as history tells us, very strongly correlated to commodity prices. So that's one factor which is driving the dollar higher. And as the demand from China looks set to continue to be strong over the medium term, that should continue. Now, secondly, interest rates are another one. Australian interest rates are around 4.75. Now, this is very high compared to other developed markets such as the US and Eurozone, which are well below 1%. So with that interest rate differential, that'll push more investors to invest in Australia, which will therefore increase the demand for Australian dollars and push it higher. And just lastly, weakness in the USA, and obviously there's been a lot of media attention about the quantitative easing or printing of money that they've been doing, which once again devalues their currency against ours. Now,
the game everybody's playing at the moment is picking how high it can go. How high do you think the Aussie dollar could climb? Are we entering a new era where this high rate could be the standard?
We definitely think that we are entering a new era or paradigm where the Australian dollar above parity is the normal. We don't really want to go out and predict where it'll go, but $1.20 potentially isn't out of the question. If Australia rises interest rates later in the year, which is predicted to happen, and the US interest rates don't seem to be going anywhere soon, that differential will remain high. And like I said before, with the commodities boom still in force, there are a couple of factors which should keep the dollar high.
Shane Oliver from AMP, could an Australian dollar above parity become a new standard, as Nathan is saying?
Yeah, I totally agree with everything Nathan said. I think the reality is that the aberration was really the period post the float. Just before that, from mid-1982 onwards, we stayed below parity against the US dollar, and that reflected an environment of very low interest rates and also an environment where Australia was seen as a poorly managed country. At one stage there, we were seen as an old economy digging stuff out of the ground. Now, of course, we've got an environment with very strong commodity prices, and Australia is seen as a much better managed economy, and of course we have those very high interest rates. So my feeling is the new norm will be above parity. Of course, it's going to remain a volatile currency, and I'd have to say that given past relationships, it wouldn't at all surprise me if at some time in the next few years we see $1.20 or maybe even as high as $1.30 against the US dollar.
Talking with Dr. Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital Investors, and Nathan Lear from the wealth management firm Hewison Private Wealth. We're talking about the Aussie dollar on Australia Talks on ABC Radio National with me, Paul Barclay. 1300 22 55 76 the number. I'll take some calls in just a moment. You can also post online. Don't forget that. Love to read your posts. So send us your thoughts online. Tell me, Shane Oliver, how would business need to adjust if the dollar went from, say, $1.07 to $1.20? Because that's another quantum leap, really, isn't it?
Yeah, I think the problem here, and this is, I think, the difference between this iteration of the mining boom and what we had last decade. Last decade, the two-speed economy was there, but it wasn't quite as painful because the Aussie dollar was coming from a record low, in fact, of 48 cents, almost 10 years ago now, up into the 70s and 80s. And of course that caused a bit of pain, but businesses were still profitable. We're now getting to a point where many businesses are becoming less profitable or not profitable at all, and that's creating a lot of pain. But I think the answer here really lies in what one of your callers said a bit earlier, and that is to source input products globally, to look at what Germany has done over the years to survive despite having a very strong Deutschmark and then going into the euro experiment with an overvalued Deutschmark. German companies have maintained their manufacturing exposure and prowess globally. And I think the key also is to make sure that productivity remains high, and that I think is the key role for the government. So Australian business can survive, but it will become tougher. Unfortunately, the alternative, if the government sort of just said, we've had enough of the floating exchange rate, let's fix it at, say, parity, I think that would just put a lot of pressure on the Reserve Bank to raise interest rates a lot more than would otherwise have been the case. Yeah. So there's no easy solution to this.
No, there's not. And I was reading also one London hedge fund predicting it could go as high as $2. Is that a bit over the top?
I tend to think that's a bit over the top. I have also seen $1.70 against the US dollar. My feeling is that would take us back to where we were in the early 1940s, which would certainly cause a lot of pain and would probably be out of the range given where commodity prices currently are. Yeah. Then again, if commodity prices keep surging like they have been, I think it's unlikely to be the case. But if that were to occur, then yes, the Aussie dollar could keep going a lot higher than what I'm saying.
Yeah, I'm going to take some calls in just a moment, so please be patient. Nathan Lear, before I do come to calls, a high Aussie dollar could potentially make Australia, I suppose, less attractive for overseas investors. How big is this risk, or is it the interest rates that are protecting the investment climate here at the moment?
Yeah, it definitely is a risk which is evident. As the dollar does increase further, overseas investors will be more cautious about the effect that's going to have on their returns. And I also did want to point out for Australian investors, another consideration is a rising Australian dollar is very negative for Australian investors that take their money and invest globally. So global returns have been quite poor over the past 10 years, and that's due to a rising Australian dollar. So many Australian investors are now thinking, well, with such a high dollar, now is probably a good time to invest into the global market. So when they bring it back, hopefully, it'll fall to 80 cents in the dollar, and they get a lot more due to the currency benefit.
Yeah, okay, I'll come back to Nathan Lear and Shane Oliver in just a tick. I want to go to Tim in Melbourne, who wants to talk about the impact on an important industry that we sometimes forget. Hello, Tim.
Hi, Paul. Thanks for having me tonight. I'd just like to make the point that there's been no mention tonight of Australia's second biggest export after coal and iron ore, which is tertiary education. And the high Australian dollar has had an enormous impact on international enrolments at some of our major universities. And this is potentially will start to have a big impact on a major income source for the country.
Do you work in the sector, Tim?
Yes, I'm an academic and researcher at Melbourne University.
And are you noticing, is Melbourne University noticing this? Because as we know, it was the overseas students that had become a very important revenue source for universities at a time when government funding was not as great as many of the universities wanted.
Very much it supports, it supports the funding and education of our national students.
Yeah.
Look, I personally don't know the numbers for Melbourne University.
No.
But, it was...
But yes, that's right. I mean, I suppose if that revenue falls, they need to find it some other way. Thanks, Tim, in Melbourne, and I'm glad you brought up the issue of tertiary education. If I can come to you, Nathan Lear, before I say goodbye to you, at what point do you think government needs to intervene if certain industries, certain export industries, really do find it just too tough? And what can governments do?
Yeah, look, government intervention is definitely a dangerous game, and many governments stay away from trying to intervene with the currency. One method, which like Shane mentioned earlier, is to actually fix the dollar at, say, parity. That's something that China actually does with their currency. Another more common way to devalue the currency, which many countries do to make their exports more attractive, is to actually print the money, or quantitative easing, which puts more supply of the money into the market and devalues that currency. Look, and these are quite unlikely. I don't see Australia adopting any of these methods because it is a risky game.
Yeah. Well, Shane Oliver, I think Australians have felt quite proud about the economic reforms that have taken place over the last 20 plus years, including the floating of the dollar. Do you agree with Nathan Lear that it's very unlikely that governments would step in with any extreme type of intervention?
I totally agree with what Nathan's saying there. I think for Australia, with the Reserve Bank to engage in what they call quantitative easing or printing money would be extremely dangerous. At this point, the US can do it because they've got 9% unemployment and lots of idle factories. We don't have that luxury. We've got 5% unemployment and an economy overall which is reasonably solid with a bit of an inflation pressure. So we can't use that option. I think the other thing Australians should bear in mind is that the Australian dollar has been the key shock absorber for the economy. Whenever the global economy has fallen out of bed, the Australian dollar has fallen, as it did, for example, early last decade at the time of the global tech wreck. And, of course, in 2008 it fell back to 60 cents. And that helped our exporters just at the right time. Now, of course, what we're seeing is the opposite. Our economy, or the mining sector, is booming. The Australian dollar is going up to take some of the heat out of the economy, stopping the economy from overheating. And I think it's doing exactly what it's designed to do. So intervening at this point, I think, would be a major mistake and could really result in a worse outcome. Particularly, it would probably result in much higher interest rates for Australians with a mortgage.
The other thing that strikes me as curious, Shane Oliver, is that Australia accounts for only 1% of the global economy, but our dollar is the fourth most traded in the world. Is the rise of our currency essentially being fueled by speculators, or does Australia, move up on the economic scale globally, if you like?
Well, we certainly have been moving up in recent years. We were on a slippery pole down up until into the 80s and 90s as our per capita income levels fell dramatically. Of course, in recent times it's been going back the other way. And I think what happens with the Australian dollar is that, yes, there's an element of speculation in there, and of course a lot of people borrowing very cheaply in US dollars and Japanese yen at near zero interest rates, parking the money in Australian dollars. And all that sort of speculation does have an impact, pushing up the volatility of the Australian dollar. But notwithstanding that, I think the broad trend in the Australian dollar has been reflective of fundamentals, and right now it's simply reflective of very strong demand for our exports.
Great to talk to Dr. Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital Investors, and Nathan Lear, Private Client Advisor with the wealth management firm Hewison Private Wealth. I'm starting to get a real understanding here of what the high Aussie dollar means, what's causing it, and where we're going. And I hope you are too. A complex interaction, as all of these economic equations are, but I hope it's starting to become clearer to you. Let's head to Victoria now. I think it's Atherley on the phone, is in the tourism game and wants to talk about the effect. Atherley, welcome to Australia Talks. Hello, are you there?
Sorry, not only tourism but wine also.
Wine as well.
Yes, we've got a double-sided business with quite a few entities, and I have to say the low Aussie dollar got us through the last 12 years of drought because we were selling probably 70% of our wine offshore to people of high net worth. And as the dollar started to rise, the exports started to frizzle out, and it's very disappointing because that's helped us to employ a lot of people in a small country region. And as our employees have, for one reason or another, gone off, moved somewhere else, travelled overseas, we've just had to take on extra work ourselves, and we're working harder than we ever have in our lives. And if the dollar's going to get higher, I cannot see how we're ever going to
I've got a terrible confession to make that I do from time to time buy wine online, and what you're saying is true, and it's reflected actually in the fact that some very good wine, quite premium wine aimed for that export market, is available now back in Australia at a bargain price, because essentially those containers have just been sitting on the dock. And basically, so they're being sold back in the local market very cheaply indeed, and I'm sure that's something that you don't welcome as well. Thanks, Atherley from Victoria, who just dropped off on us. Otherwise, I could have picked your brains a bit more. But look, let me introduce our last guest for Australia Talks for today, Nerida Cole, the Executive Director of Financial Advisory at Dixon Advisory. Nerida, welcome to Australia Talks.
Thanks, Paul, and good evening to you listeners.
Just wanted to finish up by having a brief look at the stock market. How does the high dollar affect the share market in Australia?
Well, for superannuation members and investors, it is continued tough times with the Australian dollar staying high and the expectation that interest rates are likely to go up. The effects of the two-speed economy, our view is for the Australian share market, it's not really going anywhere, which does make it difficult for super members who have a large portion of their super capital invested in the Australian share market.
So what is the relationship there between the Aussie dollar and the share market? How does the high Australian dollar put a cap, if you like, on share market growth?
Well, one of the significant contributors is that for the strong Australian dollar means that for foreign investors who do make up about 30% of ownership in Australian shares, they have more incentive to actually sell their Australian shares, because the lower their foreign currency goes, the more incentive for them to sell the Australian shares. At the moment, what we're seeing is this selling pressure isn't being taken up by Australian investors coming back into the market to buy Australian shares. And that's for a variety of reasons, but one of the significant reasons is Australian investors are not really feeling very confident about buying more Australian shares.
Yes, we did hear earlier that the fact that Australian interest rates are reasonably high by comparison with much of Europe and the United States, that was certainly pulling some investment dollars into Australia, but that's not having an impact on the share market?
Well, it has, and now we're seeing a little bit more of this, as I said, this strong Australian dollar and rising potentially Australian dollar as well, meaning then the foreign investors who actually have, now potentially that opposite problem of thinking, well, there's that incentive for them to sell their Australian shares and get their money back into their foreign currency.
I know it's a fraught business predicting stock market rises and falls, but do you think that downward pressure might be a longer-term trend in Australia?
On the Australian share market?
Yes.
Well, that's something, I guess, where our outlook is quite cautious on Australian equities, and I guess in terms of what we're sort of saying that super fund members should do is, if they haven't already, and this is for super members and in personal investors as well, is they really should be looking at reviewing their asset allocation and having a look at how much income they actually need from the investments, or are they looking for growth, all that sort of basic stuff about where they're actually investing their funds, and that'll come back to as well their overall financial position in terms of what debts they've got and what cash flow they've got coming in that's fairly reliable from salary, and their personal tolerance levels to volatility. But if they don't already, they should have a reasonable exposure to Australian cash, with it, providing about 5% in terms of returns with minimal risk. This also gives the protection if there is another correction.
There's a tip for you. Take a look at where your super is invested. Nerida, is now a bad time to purchase new shares or increase your exposure to shares? Is that essentially what you're saying?
It's something to be very, I guess, cautious of in terms of having a look at where you're invested in. If you potentially have other investments and they're not in Australian equities, it's all about that mix in terms of where they're sitting. But I guess where we're looking at the moment in terms of other asset classes, I've already sort of mentioned cash there, but it is fairly limited, I guess, in terms of, at the moment we've been looking at some high quality US residential properties for some of our investors. US equities, again, we're a little bit concerned about those, US share market, in terms of being overvalued on that side of things. So it's certainly, I guess, an area that we'd be saying that super members and investors need to have a look at what they're trying to achieve before they go investing into either Australian equities or overseas equities as well.
Yeah, it's not a problem I have excess cash at the moment as far as investing is concerned, but if it was, you seem to be saying it's quite difficult at the moment to know, if you do move out of shares, where to put your money, especially if you're looking for a reasonable rate of return.
That's right. But even, in your superannuation fund, potentially, whether it's in an industry or retail fund or wherever that's placed, there's the opportunity within that capital that you've got, and most people do have some superannuation, to look at how that's invested. And I guess what we're reminding our investors as well to keep in mind that, most of those industry and retail funds, the asset allocations that they use are, mainly designed for super members who are younger than 40 years, which might be fine while you're still trying to build up that capital and you are younger than 40 years. But if you're a bit closer to retirement, that might not be appropriate. And generally they do have a higher allocation to growth investments and a higher proportion of international investments, because that is maybe more suitable for younger people. But even for those younger people, it is worth looking at in terms of what they've got invested as well.
And for people who borrow and therefore pay the interest and invest, with interest rates likely on the rise, do they need to be cautious?
Yes, that's something as well that they should have a look at. And again, it is obviously something they need to be very careful of in terms of their individual circumstances. Not every investor is the same, but it could be worth, if their cash flow is fairly restricted or is limited, to actually look at what the fixed rate interest rates are on offer at the moment for them, and look at whether that might be an option in terms of giving them some stability to their cash flow over the next couple of years, rather than potentially facing an increase in interest rates and then not being able to service their investment portfolio. So again, as I said, that does come down to an individual decision, and whether they've got more cash flow that they might be able to then pay down the debt is, of course, another alternative as well.
A challenging time for investors. Thanks a lot, Nerida Cole, the Executive Director, Financial Advisory at Dixon Advisory. Frosty's posted online, we used to be an economy that used to make things. Now we're almost exclusively reliant on financially fickle service industries, a few holes in the ground and the raw commodities they produce. And Vincent, just on investing in shares. Invest in shares, good luck. Been there, done that, and have had unattractive capital gains loss to show for it. Okay, that's it for today's discussion on Australia Talks. Keep the discussion going on our website. In fact, get started right now on tomorrow's Australia Talks, where we're taking a look at cane toads. Once there were 102 of them back in 1935. Now there's over 1.5 billion. Can anything stop the march of the cane toad? That's on Australia Talks tomorrow. Coming up on Late Night Live, Mark Colvin talks to American historian and author Deborah Lipstadt on the 50th anniversary of the trial of Adolf Eichmann. I'm Paul Barclay. I'll speak to you again tomorrow.
Hi, I'm Monica Attard, now available as a Sunday Profile podcast. Meet the woman who heads the busiest coroner's court in the country, the New South Wales coroner Mary Jerram. She examines some of the most violent and inexplicable deaths, and she doesn't find it gruesome. Still, she'd like to see a few changes to make coronial matters easier, not only for grieving families, but also for those who might ultimately be accused of a crime. And you can hear this interview by going to the Radio National website.